Happy Sunday, everybody. Hope you're well. I realized that I never followed up on the options video, and so I'm going to do that today. Okay, so I put this into a spreadsheet. Back on July 30th, I did a video talking about the benefits of selling put options in lieu of just letting cash sit in the bank. Now, the downside is when you sell a put, that is a bullish sentiment. So you are basically betting that the stock is going to exceed the strike price that you select. Usually. Now, there are circumstances when that would not be the case, primarily if you want to take possession of shares. So if you have specific questions, I'll answer them. I'm not going to try to answer every possible variable here. Now, I will say the risk in selling puts in a bull market is that a bull market doesn't go straight up, right? It goes like this, and that means that when it goes up, before it goes up here, it will actually go doop, doop, doop. So if you are too aggressive and you're not patient enough, if you put your time, if you buy the option here, or sell it in this case, and then it goes like this during your expiration, then too bad, so sad for you. And that's what happened to me, is I knew I was being very aggressive on this, and that's why during the video, I showed a very non-aggressive way, and the non-aggressive way would have made, off the top of my head, I'm guessing it's around 10%, 6 to 10%, somewhere in that range, and they would not have been exercised. So if I absolutely did not want shares, I would have gone, and that's what I do sometimes, is if I say, okay, I know that this is my strike price, but there's an X% chance that I'll get exercised, and I do not want to get exercised, I will step it down to here. And of course, I have the share on, so hopefully that makes sense. But let me go into an example here. Okay, all right. So I'm just going to quickly review the price of gold and the price of silver on row 3 and 4 here, okay? Price of gold on January 3rd was $1,524.50. When I did the video, the price had increased to $1,974. So the price of gold on August 21st was $1,937.61. The price yesterday, or 2 days ago, on Friday, and this latest expiration was $1950.39. So I'm just doing this overview because I'm going to go back to this. The price of silver on January 3rd was $18.07. Price when I did the last video on July 31st was $23.44. Expiration number 1 on August 21st, it was $26.77, and this is very unusual. The price was also $26.77 yesterday. So in essence, it's gone up and down, but it's returned back to that same point, which is very interesting. So I will put a link to the video that I did in the description and also on the top comment. So you can click on that to watch the original interview for more information on what I'm going to describe. But I'm just going to go over the results. Per that, I enter many more orders than this, but these 4 I highlighted for this video. So I'll cover the gold first. Equinox Gold. On January 3rd, its price was $7.95. The date of the video, it had gone up $4. It was at $11.97. Okay? Which makes sense. You know, price of gold shot up, gold mine is going to shoot up. So what I did was I put in what I thought was I was fairly confident this would not be exercised, but I was very okay with taking possession of these shares because I do believe in this company. And again, you only sell puts in companies that you want to own. So on 31st of July was 11.97 is when I placed the sell put order. And I basically sold puts with a $12.50 expiration that were set to expire on August 21st. Now on August 21st, the price was $12.70, which is higher than $12.50. So those were not exercised. So I did not take possession of those shares. Instead, I was paid $1.30 per share as a premium. So each contract is 100 shares. So each contract yielded me $130. Now, what's interesting is the price of gold went down from 1974 to 1937, but the shares of Equinox still went up enough to where I was not exercised. Went up to 1270. So it went up 73 cents, even though the price of gold went down. What's interesting is if I had held on to the expiration till yesterday, it was 1210 yesterday. They were pushed down. So I would have been exercised if I went with yesterday's expiration date. Now I would have collected a higher premium. Instead of $1.30, I might have collected, say, $2, right? And so my cost basis would have been $10.50. So I still would have been way ahead of that $12.10. Now, if we go into silver, I'll start with Silvercrest Metals right here. In January 3rd, the price was $6.94. The price went up to $9.98, which is almost a 50% increase in the stock price on July 31st. And remember, silver price went from 18 to 23, so there's a reason why it went up. Because a miner, this is a silver miner, miners pull silver out, so that makes sense. Okay, so on the expiration, just less than a month later, the price of silver went from $23.44 to $26.77. So my initial thinking was correct, but you'll see the price of Silvercrest went from $9.98 back to $8.83. So I was exercised. So I chose a strike price of $10. I collected a premium of 95 cents. So my cost basis was $9.05. So I ended up paying $10 for that stock that was $8.83. So my cost basis was $9.05. So you'll see that 95 cents makes a big difference on your cost basis. So each contract is $905. So when I took possession of those shares, I paid, in essence, a net of $905. And the price on the end of the day was $883. In my view at that time, I was very happy to take possession of those shares because I looked at it as I was getting these on sale. The fact that I got that timing wrong, that's okay. I was only 17 cents off. So, and you will see that the price yesterday was back up. It was up over 10 bucks. It was $10.16. So shares that I had set for an expiration yesterday expired worthless. Well, expired without taking possession. I ended up keeping all that premium. Okay. So again, Equinox, I made money on that. I expect to make money on this. If I sold tomorrow, I would basically make over $100 per contract. So 10 contract, $1,000. So in essence, if we talk about that on a percentage basis, right? If I had sold on Friday, for example, I would have sold, we'll just use the $10.16 price. I was exercised at 905 net. So that's a 12.27% return. So you're not going to get a 12.27% return from a bank, especially when holding it for 1 month. So if we do an annualized return, that's 147% return. Not bad, not bad. I think most people would accept 147% return. Okay, so that's Silvercrest. So if we go to First Majestic, I did 2 contracts back on July 31st, but we'll just review the price. The price of First Majestic was $11.97 on January 3rd, when the price of silver was $18.07. Price of silver on July 3rd or July 31st was $23.44. The price of First Majestic was $13.33. Okay. Price of silver went to $26.77 from $23.44 on August 21st. I had sold a put contract with an expiration date of August 21st, but a strike price of $13. The price actually dropped to $11.55. My cost basis was $12. So I bought these shares at $1,300. My cost basis was $12. So each contract was $1,200 of net cost. And then the price in the account was $1,155. So I was down $45 per contract. The price is now $11.91 as of yesterday. So this one that I bought on August 21st, they're roughly break even right now. But I fully expect, and I'll go over this in a minute, I fully expect First Majestic to be over $20 by the end of the year. If it's not, then the research that I did is completely wrong. But that's what I have researched. It's what I believe in, and it's what I expect to happen. But of course, I am not always right. So the second contract was a strike price of $15. I got very aggressive here. So as you can see, the price was $11.91, which is significantly lower than $15. And this is the danger in selling puts, is if the price of the stock goes down, then you end up paying more than what you could have bought on the market. So you really didn't gain anything. But the nice thing about a $15 strike price was I collected a premium of $2.81, which is why I did it. So my cost basis was $12.19. At that time, I was like, okay, I'd rather have a cost basis of $10 if I could, but at that time on July 31st, it wasn't offering me those opportunities in this time frame. So I ended up taking possession of shares, and again, I ended up paying $15 per contract, or $1,500. And my cost basis was $1,219 after the premium. Okay. So I paid $28 more than what I could have bought them on open market. Now, I mentioned previously that options are a function of time and volatility. When I'm going to sell an option, sell a put option, on September 18th expiration, when it's July 31st, I'm expecting a higher premium. As you go farther out, your premiums increase. So as you tie up your money longer, you want a higher return. So it's a little disappointing when it doesn't work out that way. $281 per contract would be an 18.73% return because it's tying up $1,500 of my money in my account. This is something as a trader that I sometimes still struggle with, is when I see this happen, I'm like, oh man, I would have much rather had preferred selling a put option at say $10 and collecting that same premium if I had waited, right? Okay, so right now, if I sold more puts on First Majestic on Friday, the current price is $11.91, right? The price before was $13.33 when I did the last one. So if I did now a $13, well, actually I called up this. So if I did let's just go down to October 30th, we'll say, you'll see a $13 is going to pay roughly $1.80. And last time I collected $1. So you see 80% more premium. Now, I think silver is going higher. I think it will happen this year. It will move higher, and it will continue next year. And I think what's happening right now is I think First Majestic, it's been beaten down for many, many years. And now that the price of silver is higher, this company is going to have to prove that all that silver it's mining is going to generate a profit for the company. Now, it had COVID shutdowns earlier this year, which affected its numbers. They couldn't mine, so they couldn't generate revenue. In addition, the CEO of the company, Keith Neumeyer, I think he made an excellent decision when silver was beaten down to less than $12 an ounce. He said, I'm not going to sell it at that price. It's like if you took $10 out of your pocket and threw it in with every box you sold or whatever you sell. Just doesn't make sense. You were better off taking a loan and living off the interest if you had to, rather than doing that. Now they have $120 million in their coffers, so they could ride that wave, and it was a good decision because now that silver that he didn't sell at $12, he sold instead at $25. So he doubled his revenue just by holding it. That's a very good decision. Instead of caving in saying, well, I have to sell what the market says. No, you don't. It's your company. So I think they will be rewarded for that. And I think its shareholders will be rewarded for that as well. In addition, the banksters are pushing down. They short First Majestic. They short his company whenever they can. So this, in my opinion, this price of $11.55 and $11.91, it is a gift. And if it goes down to $10, it will be a bigger gift. And in my opinion, and I have to say that because it is just my opinion, because I don't know the future, but I am fairly confident that this stock will be $20 by the end of the year. And if not $20, I'll be surprised, number one. If you have the ability to sell puts, I would strongly recommend that you look at the January or even April. And if you wanted to be conservative, you go with the current price. And the current price for $12 is going to pay $2 per contract, which is almost 17% return for holding October's 1 month, November, December, January, 4 months. 4 months to earn 17%. Now, if the price drops down to $10, could it? Yeah, it absolutely could. Could. I mean, these are, you'd like to think you have free markets. You don't. The powers that be move them wherever they want them to go. But the nice thing is the cost basis on a $2 premium on a $12 strike puts you at $10. So it provides a nice buffer if that should happen. And that's what this is. Investing is a game of chance. It's a game of chance. There are no guarantees. So you take the information that you accumulate and you make your bet. You make your decisions. If you are going to, unfortunately, they've corralled everybody to go into the markets because I don't know about you, but I can't make it on a 1% return. But even if you wanted no risk at all, and when I say no risk, there's always going to be some risk. But if we just went with a $10, at $10, it's still paying $1. That's 10%. So your cost basis would be 903. If I had unlimited money, I would put a couple $1 million into that, because if you did $10,000 in that, that would be 10 contracts, because each contract's $1,000, and you'd collect $100. So you'd be collecting $1,000 on a $10,000 bet. That's pretty darn good. And the reason I wouldn't mind a $15 price in January is because I believe it's going to be 20. So I'm actually leaving $5. If I knew for a fact that the price was going to be $20 in the end of the year, then I would select the $20 price. And I would collect $8.53. Now you could also, the other thing you can do is you can buy call options. I'll review that if people are interested, but I didn't want to start trying to cover 50 different ways to trade a stock. I'm basically just reviewing in these videos sell puts. So this would collect, if I actually did, if I did a $10,000, I could only do 5 contracts because it's a $20 strike price. But even if I do 5 contracts, 5 times 950, right? That's $4,250. So that'd be 128% annual return, roughly. Hi there. So as you saw in this video, the downside of selling puts is that you have to have cash in your account to take possession of shares, okay? And after you take possession of shares, you can turn around and sell it. You can turn around and sell a covered call, or you can hold it and let them appreciate. Those are your options. All right. If you have any questions, leave it below. All of these trades, I'm going to make money on it. Maybe I'm not going to make as much of a return as I would like, but you don't always hit a home run. Sometimes you hit singles, sometimes you hit doubles. And that's where sizing your positions comes into play. If I had $100, I wouldn't put all $100 on one trade, right? I would try to mix and match, and I would always leave, and this is different comfort levels for different people, you should always leave a certain percentage in cash as liquidity for unforeseen and unexpected events, so that if something happens that you don't expect, you can ride it. You can ride it. The worst thing you can do is max out your account because you think you're 100% right. And I've done this. So I'm speaking from experience. And then the market says, oh, smart boy. And then if you had liquidity, you'd be like, okay, no problem. But because you don't have liquidity, you now have to, you get margin calls, or you're just forced to sell things. And now you have to pick winners and losers. Sometimes you have to sell things at a loss because you need the cash. You learn very quickly not to do that. Some people, unluckily, blow up their accounts and they have to learn with a whole new account. Thank God, thank you, Lord Jesus, I have never had to suffer that. But I have lost money having to liquidate things to keep things that I wanted to keep because I couldn't hold on to these losers waiting for them to rebound. Maybe it was a blessing in disguise. And in some cases it was. In some cases it actually was. Some cases I was forced to sell things that I didn't want to sell, and they went, ooh, and I was like, wow, I'm glad I got out of that thing. Saved me a bundle. Okay, that's it for today. Have a happy Sunday. I hope this helps. I strongly recommend, I've helped several people get into doing this, and I tell them all the same thing. If you have, we'll say, if you have $100,000, don't trade the whole $100,000. Take 10 grand and try doing this with 10 grand. Obviously, your returns are going to be lower, but build up the confidence. Try it. This takes some time to really get a rhythm on knowing what you're doing. And so $10,000 on a $100,000 account, that's a good starting point. Good starting point until you know what you're doing. Okay? And then if you have questions, put them in the comments below or send me an email. Thanks. Bye-bye.